Okay, welcome back to the Top Dog Swing Trading course. We're looking at volume, and now we're going to go into rules 4 and 5. And all of these rules basically give you trading scenarios or setups with regard to volume. Now, again, none of these would be taken by themselves. It's just one more energy that we would add. We want to see other energies align with it. But we're not going into all of that right now. Later in the course, I think the last video actually, we'll put everything together. But right now, we want to just focus on volume to make sure you understand those patterns without confusing you with all the other information at the same time. Okay, so let's go into volume rule number 4. And this is a very special one. It's one of those that doesn't occur very often, but quite often that's the case with the best trade setups, is that they're rare. They don't occur very often. The market is never going to just drop oodles of cash in your lap for nothing. It rewards the people who are patient. So this is one of those trades where if you're patient and you keep watching for it, and when it eventually shows up, it can be a tremendous trade. It has a real good win-loss ratio and a really, really good risk-reward ratio as well. It's one of those things that combines both. So stay alert for it, and let's get right into it so you know what it is. And it's actually a pretty simple thing. But before we get to that, let's go ahead and analyze this whole chart. Just a little review. So we're in an uptrend over here on the left-hand side of the chart. And I kind of use this boxing technique because the volume histogram can be difficult to read on a bar-by-bar basis. I create these little boxes. I'd make this one actually about there. Now, so we're going from here. It's kind of a stair-step pattern. This is basically what you want to see. Stair-step as you're going up. That's good. So this box is a little higher than that one. So that cycle low is a good trade. And we get our next cycle low down here. We get another increase in volume. So it's good. It's going in our direction basically. But then the next box is down here. And then the next box is down here. So the stair step starts going back down. Volume reaches its climax in the middle of the trend. So here's where volume can be a leading indicator, showing that even though price is going up, it's going up on less volume. Volume is declining. Now, I suppose a natural question would be, well, Barry, how do you know how to draw these boxes? Well, you just eyeball it. I mean, you can see what I'm doing here. I'm just looking for the, the highs of most of the bars in this area, and the highs of most of the bars in this area, the highs here, the highs here. Just find, where you got, I would say at least 3 or 4 minimum. This one is shorter just because that movement is shorter, but it's clear, it really stands out in the chart. And then again down here we could connect those 4 or 5 bars down there. And you don't have to make a whole box, you can just do horizontal lines if you want. But this gives you a rough idea of the stair-step nature of volume, as opposed to trying to read each individual bar, which really is not that accurate. It's very not that helpful, in fact. Certain volume bars are important, and others are just noise. It's just the market. A little bit of extra volume, a little bit of less. It's insignificant, but it's the overall pattern that is significant. So doing this little boxing pattern, a little stair-step pattern, whichever you want to call it, can be very, very helpful. And again, start warning you when the trend is starting to lose some interest among buyers. It's a supply-demand signal. and it can be an early signal for you. Okay, now let's take that off and let's look at this bar here. Now this is the highest bar on the whole chart, and that comes right at the top there. So this is a great indication that hey, you know, that's a problem. That is a spike of volume that comes late in the trend after volume has been coming out of the market, and so we actually get a spike in volume, which can be a reversal pattern. Then we get this bar right here. Well, let's go ahead and leave that on too. Now that one's coming down, and we've got a wide range red bar, a little bit of a tongue twister there, and it's on good volume. So this marks climactic volume, this marks reversal volume. Then we come back down to the 50 MA, get stuck in the moving averages, pinball pattern. As we come back up, volume goes down very low. And then, as we reach the top of this cycle high, volume gets minuscule. So here's our stair-step pattern again, and it is bad for this up move, which actually is good if you went short. Then that's confirming that, okay, I'm doing all right, this is good, everything as far as volume goes is still lining up for me. And you get a little convergence pattern, which is great. Then we start our down move, this half cycle, and volume picks up again. So again, that's good for your short. So now we're saying good. We've gone down, down, up on the down moves. This is good for the shorts. Then what happens? Well, then the market goes sideways. And we get stuck into this little sideways choppy pattern. And volume doesn't increase, and it just kind of, doesn't show much of any real good pattern. It gets real short there, get a little extra here, but it's just equal to this. There's no increase in volume. It's not a, and then down here it gets really, really puny. And this is pretty typical of your sideways markets, right? Low volume. But then, and here's where rule number 4 comes in. Then we get a spike in volume right here. And this goes above all of this. And that's the key. You really want a spike that doesn't just come back into this range, but it shows a whole new range getting above that. And that's what this does. So there's 3 keys to rule number 4. Number 1, a spike in volume, and by a spike, that's what I mean. It creates a new higher range than we've seen for quite a while. Number 2, price is in consolidation. Very important that the overall pattern of price has been in consolidation for a while. And then the third aspect of rule number 4 is that this spike in volume, occurs on a very narrow range bar. So that not only is the overall pattern going sideways, but the bar itself on which that volume spike occurs is very narrow range. So let me take all my gibberish off there and show you exactly where that comes in. It comes in right on that little bar right there. Okay, and if I remove that line, you can see what a narrow range bar that is. And that's a beautiful thing, because this defines your risk. Now, what's happening here is volume is giving us a leading indication of price. It's another example of how volume can lead price. And it's telling us that even though price hasn't moved significantly yet, in fact it's not moving at all, it's a doji, and that's even an inside bar to the last little doji, there's some underlying buying and selling going on that is significant, very significant. And things are starting to shift, and people are starting to take interest. And so something's going to pop. Well, that's great. We want to be in on that pop. This is kind of a variation of the expansion-contraction pattern, or the ex-con trade, except now we're using volume. So we're in a contraction pattern. We're looking for a clue that we're about to go into an expansion of energy, and volume is telling us that. It's saying, we're getting a build up, build up, build up, build up. Everybody's getting in, everyone's getting in, and as people are getting in, this thing's going to pop one way or the other. Now, generally, what we want to do is we want to trade this in the direction of all of our other technicals. We want everything else to line up that we normally trade. And that includes your trend, your cycle, your next higher time frame, and so forth. Generally, you trade the breakout of that bar. One tick below the low of the bar, one tick above the high of the bar. But, again, it's best if it is in the direction of all your other indicators. Now this one just happens to be super sweet. And it's super sweet because it's a first retrace in a trend. This whole thing is the first retrace in the trend. So structurally, it's a great trade. Number two, we've got a convergence pattern on stochastics, and we love those. And of course we've got resistance here, a cluster of resistance as well with the 100 MA and the 15 EMA. So this one has just all kinds of stuff going for it if we go short. I'd be nervous about taking this one long. But going short, yeah, I'm all over it for sure. And again, your risk is so small and your reward is, it's very good. Now again, these volume patterns are only worth a half cycle. So once we get down to the end of this half cycle, we're going to have to reevaluate now where is volume at this point, where are indicators at this point, and reevaluate everything. But it's a very, very good indication of what's going to happen on this next half cycle. We can get in on that with high confidence and a high probability trade, and usually a very, very good risk reward because the bars are so narrow, and that volume buildup normally means you're going to get a pretty good range on your move out of that. Okay, so that's rule number 4. Let's move on to rule number 5. Okay, rule number 5 has to do with major tops and bottoms, although these rules really can apply for other areas as well. In fact, we're going to show a variation of it in the next video. But here's what we're looking for. We're putting in a top in the market here. And what we want to see is for the market to come down, and this applies for bottoms as well, and then to retest this high. Okay, so it comes down, comes back up to retest. Now, and you can see that with your cycle indicator here. Now, this retest, it can do one of 3 things. Number 1, it can form a little bit of a lower high. That's what happens in this scenario, and that's perfectly fine. We still consider that a retest. It can go up here and put in pretty much an equal high, and that would be a nice double top. Or it could even go up and put in a little bit of a higher high. We still consider that just a retest. My favorite scenario is when it does put in a higher high and then creates a candlestick bar that looks something like this. Okay, and the reason I like that, this can have several little variations, but this is really the key, is that the real body stays down here in the range of this high, but the wick or the shadow makes the higher high. And what that really means is that the market started down here, it went up and tested this price level up here, and it didn't find enough buyers. People said, no, I'm not going to pay that much for, this is the Dow Jones Real Estate Index. And so then it had to come all the way back down before people would actually start trading it again. So what that means is these prices up here have been rejected by the market participants. They've said, no, this market right now is not worth that much. That's overpriced. We're not going to buy at those levels. And because it's rejecting these price levels up here, it's natural for then the market to start going down. And I love that. There's other reasons too. Stops are taken out here and so forth. So that's the price pattern we're looking for. So again, it could be a little bit of a lower high, a little bit of a higher high, or an equal high. Okay, so that's as far as price goes. Now, volume. What we want to see on volume is more volume here than here. And what's the reasoning for that? Well, it really goes back, it all kind of goes back to rule number one. Rule number one is the controlling rule of all the rules. So it's just different ways. All these different rules are really just different ways of applying rule number one, if you think about it. So what do we see? Well, we want to see as this market comes back up to retest this high, we want to see it be weak. We don't want to see a lot of strength behind this up move, if we're going to go short, that is. And that's what this is all about. It's about taking a reversal trade. So this will give you another clue in your reversal trades. So what do we have? Well, let's analyze this bar by bar here, because I said that volume doesn't, coincide with bar by bar that accurately. But having said that, I do need to put in a caveat that the volume is measuring each one of these bars. That is what it's literally doing. So you do need to notice which bar is creating which volume histogram down here, because that does have meaning. Even though it doesn't always have meaning, you need to note it. You need to know which price bar is creating which volume histogram, just in case it does line up perfectly, which sometimes it does. So what's happening here is on this one, we're getting a spike of volume. Okay, and that is on that one and on this one. Now that is climactic volume. It's a climax of volume. And that's the first clue that we're going to look for on rule number 5. We want to see a climax of volume on that first push to a new high. Now, again, looking to the right, you might say, well, it doesn't look like a climax of volume, but we're trading the hard right edge of the screen, and we're up to this level. And you'll notice, otherwise, volume has been down at this level. So on the hard right edge of the screen, without seeing this big red bar here, that's going to be, a major, the volume has doubled at this high. So that's a climax of volume, and if it happens late in the trend, then that usually is a sign of a top. Then the market comes down and volume goes down. Okay, good, except for this bar right here. Okay, the big bar actually occurs on a down bar coming off of the high. So that technically is not a climactic volume bar right there. That is actually volume confirming the move down. In other words, this is rule 2. This is where on the retrace volume is increasing. And even on this one, that red bar, look, that's even higher than the climactic volume was. So this is saying, okay, we get a climax of volume, and then boom, as volume comes down, whoa, it's coming down on even bigger volume. We don't want to see a retrace on big volume if we want to go long. But that's exactly what we're getting. Well, what's that mean? It means we don't want to go long. So we say, okay, climax of volume often marks tops. We get big volume on the retrace. Oh, that often marks reversals. Let's look for the next high. Let's see what that tells us here. Well, as the market moves back up, volume goes down. So now we're saying, okay, well that actually confirms this reversal pattern. So we've got three things confirming the reversal pattern. The spike in volume, climax, retrace on increasing volume, move back up on lower volume, and then here's really where rule number 5 comes in, is this high, the second high, this retrace. Where is volume there? Now sometimes we will get another spike of volume here, and sometimes we won't. But either way, what we want to see is very simply less volume. So we want to, and again, it all starts with this spike. This is only, this rule number 5, only applies when you get a volume spike, a climactic volume spike. So then boom here, let's actually do our vertical lines, boom, 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 boom. And then where's our next volume increase come? Right there. And now see, price is already coming down. So we've got a much lower high on volume, and that's what you want. Okay, let's look at another example here real quick. Okay, just to bring clarity to this, we'll look at another spot here on the same chart. First of all, just wanted to point out that, well, anyway, we'll look at all these lows, doesn't really matter. Lows, 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 lows. None of these lows have spike volume bars on them, do they? None of them. Okay, here, again, still not really, because that's pretty equal to that. But here we do. So again, we're getting really our stir step situation here. That's real little. This is all pretty close to the same. Yeah, that's even pretty close to the same. But then boom, here we get a nice spike that just stands head and shoulders above this. And again, sometimes people visually look at this and say, well, I don't know, is that really a significant increase in volume or not? And my basic rule is very, very simple. If you're not sure, then the answer is no, it's not. Because little increases in volume are not necessarily that significant. What we're looking for, and we call that a volume spike, what we're really meaning is it just boom, stands out on the chart like a sore thumb. You can't miss it. Anybody looking at that would say, holy mackerel, yeah, that's a volume spike. So if you don't feel that way about it, don't treat it that way. So here's a low, and again we get our candlestick pattern, which is nice, hammer. Okay, we get a spike in volume, and so that can mark a low. Notice how the spike in volume occurs right on the bar. That's really what you need for an exhaustion volume pattern. Okay, you don't need that for rule number 1 or even rule number 2 really, but for these exhaustion patterns, that's what you need. You want it on the low. Then it comes up, it comes down. Okay, now we've got our retest. Now, here's what I really wanted to point out here. Quiz time. Well, no, we won't do a quiz. Too early for a quiz. You're still in learning mode here. So we come back down, we retest this. Now, we just said that we want this retest to be on smaller volume, but what do we have? We have bigger volume, don't we? Let me get this line off of here. And it's clear, again, just stands out like a sore thumb, that that volume bar is a lot bigger than that one. So now wait a minute, Barry, what's going on? You said you wanted smaller volume on the retest. Yes, but this is an exception because of the candlestick pattern. This is an engulfing candlestick pattern, and the key is this green bar is what creates this volume increase, and it's going, it starts here at the low, retest this, starts at the low and closes at the high with big volume, and it is saying there is a truckload of buying here. And so therefore the energy here is buy, 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 buy. So this does not meet rule number 5. This is not the rule number 5 pattern, but don't discount this pattern. Remember, we've got 7 rules, not just one. This is another pattern. This one would fall under the candlestick pattern, and with this major volume, retesting this low and major volume right on this engulfing green bar, which is a wide range bar that is lower, well, the real body is lower than the real body of the previous bar and higher than the real body of the previous bar. So it engulfs it, and it's wide range, and it opens at the low and closes at or near the high, and it's on this mega volume, and it's bouncing off of this previous low. That is a great pattern. So just wanted to clarify that don't think that all of these double bottoms have to fit for Rule 5. Rule 5 is only one way the market can put in a double bottom. There are others, and these kind of candlestick patterns with mega volume are really, really good. In fact, maybe even more reliable than rule number 5. Okay, that's it for this video.